Are you an early stage founder revolutionizing the future of retail? Then you're in the right place. My name is Shah, and I'm an angel investor investing at the pre-seed stage in retail tech, e-commerce, marketplaces, and digitally native brands. I'm also the founder of Retail X Series, an ecosystem to help early stage founders in the retail sector. Retail X Series includes events, a YouTube channel, a Slack community, resources for founders, and this podcast. And in this podcast, I interview founders, investors, and experts in the retail space, and we dig deep into the tactics around key topics that early stage founders want to hear about. Welcome to the Retail X podcast. Hello, everyone. Welcome to the Retail X Series podcast. I'm your host, Shah. In today's episode, we'll be talking about cap tables. What are they, why they're important, and what you need to know when you raise outside capital. Our guest today, Allison Cooper, is corporate partner at Fenwick & West. Welcome to the podcast, Allison.
Thank you. I am thrilled to be here. So, just a little bit about Fenwick & West. It's a leading technology and life sciences law firm. And my practice here focuses on working with startup companies. So everything from two founders and an idea through, companies that are exiting in an IPO or an M&A transaction. And I work with a wide variety of companies. So, consumer-facing products, high-end retail goods, AI technology. But what I'm especially passionate about is working with female entrepreneurs and underrepresented minority founders. And as a startup attorney, I get to basically operate as an outside GCs and business advisor. So I can help my clients through a myriad of issues, everything in their life cycles from the first time they hire someone, the first time they fire someone, and then, of course, all of their raising money.
Well, that's really helpful because I think that is going to be great context for what we're talking about today. So let's get going with kind of some basics about cap tables. I think that most founders, when you say the words cap table, they know that it's their ownership in their company, which, at that earliest stage is just the kind of founders before any outside capital is raised. And then the subsequent fundraising rounds are clearly reflected on this document. But what else should founders know at that very beginning in terms of sort of cap table basics, and how early should they even be thinking about their cap tables?
Yeah, so I think that, first thing first is you should be thinking about your cap table from day one. And I'm a visual person, so I really like to think about a cap table as kind of, a big pizza or a pie. And really all of the equity interests just add up to 100%. So the more people you add to the cap table, or, so the more employees you hire, or the more investors come on board, just the smaller the pieces get. So I think the important thing to really pay attention to is that your cap table should really reflect the full ownership picture of your business. And everybody should be accurately, and completely reflected on the cap table so that everybody knows how big their piece of pie is, right? They want to know how big their slice is. And I think that's the important thing. So it really should always be an accurate snapshot at any point in time. And so you should think about it from day one, but you also need to think about it on days 2, 3, 4, and 100.
Got it. Okay. So are there goals of ownership that founders should have at each milestone? I get asked this question a lot. If I raise a friends and family round or a pre-seed round, like how much should I or my founding team own of the company at each point?
So I don't think there's a hard and fast rule, but there are certain kind of trends and some kind of, market standards. And there are actually companies that track this information. And I think it can be super impactful, no pun intended, because one of the leading companies that tracks it is called Option Impact. But anecdotally, I can tell you that what I typically see is founders, kind of together with their early employees and advisors, will tend to hold the majority of the company's ownership through the first round of institutional fundraising. After the first round, though, then the cap table kind of will usually shift in favor of the investors. And so that's what I tend to see kind of anecdotally. And that kind of makes sense, right? Because, investors at the early stages are really looking to get maybe 20% of the company is usually what they're aiming for. So when you factor in kind of, what the lead investor is going to get, what the size of the option pool is, and then what the investors have, it makes sense that the early founders and kind of, early employees would have a majority of the cap table. And then, of course, that starts to decrease as you later take on more investment. But the good news here is that, I wouldn't really kind of worry too much about that shift in ownership from, founders to the investors. It's completely natural. And what we know that because of like the economics of fundraising, it tends to be that the Series seed investors are generally pretty closely economically aligned with the founders because the price that they're buying stock at is usually pretty low. And it also makes good sense for them to kind of set good market terms because the next investors, your Series A investors, your Series B investors, Series C investors, are always going to ask for whatever the Series Seed investors got plus more. And so if you ask for things like participating preferred, that not only hurts the founders, but that's also going to hurt the Series Seed holders. And so usually we see kind of a pretty nice alignment between the Series Seed investors and the founders. And I think that's a really good kind of bonus.
That's really helpful. And I think, we could probably have an entire conversation on liquidation preferences and things like that, but we won't because that gets too technical for a podcast. But let's talk about, you mentioned Series Seed investors, but nowadays, before you kind of get to that seed round, I feel like there are a million other rounds to go through before that. So you might be a startup that goes through an accelerator program and you got a safe note from an accelerator. You might raise some friends and family and maybe you did that on a safe, maybe you did it on a convertible note. And then you might raise a pre-seed on another safe or convertible note. And so you're not really pricing something and really having that formal price round until seed or later. Is that what you're typically seeing? I mean, that's sort of what I'm seeing right now, but is that what you're seeing? And is that good or bad?
So I think that's exactly right. I think we tend to see, there's not really one standard playbook, but I do think it's increasingly rare for a, kind of the self-funded startup that really is just kind of just funded by the founder. So oftentimes we'll see a company that has some incubator shares in there. Maybe they've gone through an incubator or an accelerator program. There will be some safes on there or some convertible notes that are all going to convert into preferred stock. Less often we will see companies that have participated in multiple accelerators. So maybe they go to one accelerator and then they go to another one. And that's okay, because if that's what they needed to do, that's fine. But equity can be expensive. So the equity they're giving up for those programs can be expensive, and it's just important to keep note of. But I think when you're kind of looking at this holistically, I think it's really important to kind of zoom out and look at this the way an investor would look at it. So when you're looking at your cap table, we know that investors like simple cap tables. An investor wants to be able to come forward and say, if I invest $10, I get X percentage of the company. And I think that's really important because that means that, you want to not have overly complicated terms in your safes or your notes. And you don't want kind of multiple instruments on different terms. You really want to make sure to keep things as simple as humanly possible. And that's also going to cut down your legal costs.
Yeah, that's a really great point, because I know there have been times, and I think this happens to founders more and more with those kind of incubators and then a pre-seed or a friends and family, where the founder is not really sure in that period before they go out and raise a price round or a seed, how all of those things convert. What do you recommend to founders to do at each of those stages, like that first accelerator, maybe safe, and then that pre-seed, that might be a node, and then there might be another safe thrown in there? How do you recommend that founders keep track of that so that they do understand how each of these things is converting or will potentially convert in the future?
So I think it's a two-step process. The first is keeping accurate records. The worst thing is for you to think that you have an accurate view of your cap table only to find at the time of financing you actually own less of your company than you do because you've got some kind of instrument that's converting. I've seen that movie, and it is not a good movie. The other thing I think is you really actually have to model these things out. And I think that can be scary to people. For me, when I was, 10 years ago, when I was a very junior lawyer, I had no idea how much math I would be doing. I really didn't. I had no idea how much I would be working with Excel. But I am by no means an expert, but I can tell you I'm comfortable with it. And I think that should be the goal for every founder. You really should get comfortable with Excel. You should get comfortable with modeling. And we actually have a lot of the capitalization programs that you can kind of sign up for now that actually have some of these. They're really starting to develop, this modeling to make it easier on you. But generally speaking, and I also, as a lawyer, I also will provide my clients with kind of simple pro forma cap tables so that they can actually model out this dilution, because you can do that, based on a small number of variables. You can actually see what the dilutive impact of these types of, convertible securities, the safes, the notes are going to be like. So you can say, hey, if I raise, the variables are going to be your pre-money valuation, how much you're raising, and the size of your option pool are probably the three biggest variables. And if you kind of take some good guesstimates about those things, you can really see what this is going to look like if you take on a safe with these terms or a note with these terms. And I think that's kind of the biggest kind of name of the game, is get comfortable modeling and really understand what it is you're signing up for.
So you mentioned two things that I want to follow up there is that you're going to model it out so that you can see what the dilution would look like. But it also sounds like you're saying you should actually do a couple scenarios because you don't know what that next round's going to look like. So maybe like your dream scenario, if you're raising at a great valuation, and then maybe something that's more realistic, and then maybe something that's even like not as good as you might expect.
That's exactly right. So that is the brilliance actually of a lot of these cap tables. Certainly the ones that I put together are dynamic models. So you really can plug and play. So you can say, okay, what if my pre-money valuation is $10 million? What if my pre-money valuation is $20 million? What does that look like for me? And I think that also helps because it helps with your bargaining power. You can really understand what types of terms you were willing to accept from investors, and also kind of how much, for example, I think early kind of equity that you take on may also be some of your most expensive equity, because they're going to be getting kind of more of the cap table than later rounds when your company is worth more. So thinking about, should I really be taking on this extra 100K of safes? Man, it might help my company a little bit, but do I really need it? You can model that out and see what that $100,000 is actually going to cost you.
Yeah, that's really good advice. And let's go back to the other thing you said about option pools. Is there a standard at that earliest kind of, even at sort of pre-seed and then at seed, that founders should be modeling? Because, even if they haven't sort of created an option pool yet, or they haven't hired employees, they should be thinking about it obviously ahead of time.
I think absolutely. So first things first is when you incorporate your company, your option pool costs you nothing. So it is really just this reserved bucket of shares. And if you don't grant anything out of that, it really means nothing. If you don't grant anything out of it, then there's no dilutive impact to you. But what we typically would advise it is at incorporation, you should probably reserve maybe 10 to 15% of your fully diluted for an option pool. And that'll allow for you to grant equity to your employees, your advisors, your consultants, your service providers. But usually when a preferred round lead investor comes in, they're going to say, we want you to have enough dry powder. We want you to have enough available in your option pool to grant to any new hires for the next 12, 18, 24 months. So usually, and somehow magically, that number always ends up being about 10%. So they usually want you to have a 10% available pool. So what that means is if you are below 10%, they're going to want you to increase it. That doesn't mean that you need to do so before the financing or you need to do anything kind of preemptively. But you should just, as you are modeling, think through if your option pool is below that, they are likely to ask you to increase it. And you increase it, even though it's calculated on a post-money basis after the investment, you're going to increase it pre-money. So what does that mean? That means that the founders bear the dilution of the option pool increase, not the new investors.
I think that's a really good point that you just made. And I think that's actually maybe a point that we should talk about with multiple safes and notes converting into a price round as well, is that it is not always clear, I think, from at least, listen, I'm not a lawyer, but it's not always clear to me reading the documents as a non-lawyer how things convert and how that option pool is, who that's diluting and all of those sorts of things. Is there kind of a standard, like if let's go back to our example that we've talked about. I have a safe from an accelerator. I did a pre-seed on a convertible note. I'm now doing a priced seed round. How do those two things convert? Are they both diluting the founders and the option holders? Or is the note also diluting the safe holders? Like, how does that typically work, or how should it work?
So I think it depends on how it works and who it dilutes, depends on whose seat you sit on. If you are a new investor, all of that should happen before your view anyway, and depending on kind of how much bargaining power each person has. But if you are a new investor coming in, your view is that all of that stuff needs to happen before you even put your money in. So option pool increase, conversion of safes, conversion of notes, that all happens before you even put your money in. If you are a founder, you are generally speaking going to get diluted by all of this stuff. If you are a safe holder or a note holder, what I typically provide in my documents, because I think this is the fairest way, is that it would convert on a pre-money basis, but the way that you convert it does not take into account those convertible instruments themselves. So what does that mean? It means that because when you are calculating the conversion price, and we're getting a little bit technical here, but I think it's important to know. When you're calculating the conversion price, you basically use a price that's based on how many shares are outstanding prior to the financing. And so when you're looking at how many shares are outstanding prior to the financing, you look at everything that's actually been granted, the size of the option pool, but you also look at the number of shares that are being issued in connection with the SAFE or the note. For new investors, it makes sense that SAFE and note themselves are included in that calculation. But I think it's unfair for the SAFE and the note holders to use their own shares to drive down their own price. To me, that feels like double dipping. Right. So I usually specifically carve that out. So what it means is that founders get a little bit of a break when it comes to the SAFE and note holder conversion price. And at the end of the day, you kind of have three buckets of people. The first bucket are the founders, the second bucket are the convertible note holders, and the third bucket is going to be the investors. And each of them kind of sit in different shoes.
So in that example, and I do feel like we're getting a little technical here, but I also think people ask me these questions and I'm not 100% sure I have the right answer for them. In that scenario, are the SAFE and note holders kind of in one bucket that you've carved them out into one bucket, or are they two separate buckets?
They are going to be in two separate buckets depending on their terms. But if I'm your lawyer, I'm going to make sure that they are both in the same bucket as far as that one conversion piece. So maybe their terms may convert a little bit differently, but they should both be, when I'm thinking about what is excluded for purposes of calculating that conversion price, I'm going to make sure that I am talking about all the notes, all the safes, everything. So if you're my client, they will be in the same bucket. Sometimes other lawyers kind of don't, do that as well, but I think that's the fairest way to do it.
It's interesting because I think this brings up maybe the reason I wanted to have this conversation with you and record it for the podcast is that this is all kind of complicated, right? For founders, especially if you're a first-time founder, you've never been through it before. And to your point, if you're not good at modeling and Excel, or if you're like me, where you read a lot of legal documents, but maybe you don't understand 100% of what you're reading, you do need a little bit more kind of advice on some of this. And I think it is hard to think through some of it. So I appreciate kind of that more technical perspective. And that sort of leads me to my next question, which is, many founders are worried about having too many people on the cap table, particularly before a price round with like a lead VC. Maybe it's like they took in a lot of small checks from friends and family, like, $2,000 checks, $5,000 checks. Maybe it's just that they have like all these different, the accelerator, the note, kind of multiple things like that. Should founders be concerned about this in their early cap tables?
So I actually think this is a really valid concern. And I think there are a couple of reasons, probably three big reasons. The first is that small check sizes can actually be indicative of that someone is maybe a non-accredited investor. And when we're looking at investors, we want to make sure that we are taking on investments in compliance with securities laws. So when people do a friends and family round, it doesn't necessarily mean that we can really just get money from all of our friends and family, right? Instead, friends and family round really means that we should be looking toward our wealthy friends and our wealthy family. So those people who can really shoulder the burden of losing all of their investment if it goes belly up. And so I think that's kind of important to pay attention to. So small check sizes in and of themselves, don't necessarily mean something, but I think they can kind of be indicators. The second thing is that I think people forget that if you take on kind of small amounts of money from a bunch of different people, you have to make sure you maintain contact with them. You can't lose touch with them, because when those notes convert, when the safes convert, these folks are going to have to sign some paperwork, and it's going to be a condition of closing, right? They are going to need to sign on to these future documents. So if you're having to hunt someone down in Antarctica that you haven't talked to in 10 years, that can be a problem. And similarly, if we have to ever amend these documents, you have to get to a majority in interest of these folks. So if you have to go to 16 people to get a majority, it can really be a headache, and can be, you're over here trying to run a business. And in the meantime, you're also having to track people down on LinkedIn. It can be really tough. And then I think the third piece is something I previously mentioned, which is simplicity is king. When investors come in, they want to see a simple cap table. They want to be able to easily discern what their ownership percentage of the company is going to be if they invest a certain amount of money. And that becomes increasingly more difficult the more noise there is on a cap table. So I think those three things, lend toward kind of having bigger check sizes if you can swing it. I know not everybody is that lucky, but if you can get people to give a bigger check size and have kind of maybe one big lead investor with maybe some other smaller ones, and also to have really simple terms in your notes and your safes, very simple terms, very industry standard terms, and also making sure that you don't have kind of multiple sets of those on differing terms.
Okay, so I want to pick up on what you just ended that with, which is, I see this a lot, particularly in founders that have maybe had to pivot their business, or, there was a COVID impact and they didn't get to those metrics to raise the price round. And so they raised kind of another something, safe or note or something. How many of those kind of safes and notes is too many before a price round?
I also have seen it where we have multiple rounds of kind of, pre-seed funding. And I don't know if there is a hard and fast rule for how many is too many, but I will say kind of one thing that I think people kind of forget to pay attention to. So there are, and again, this is kind of one of these things where it's like, make sure you're talking to your lawyer, because anytime you're issuing, securities, there are always securities laws risks that we have to just make sure we're paying attention to. And so I think the biggest issue that I see is actually when people are issuing securities on different terms at the same time. The securities laws don't like that, because you were basically saying to one person, hey, my company's worth X, you should invest on these terms, and saying to someone else, you should invest on these other terms. And if they don't know about each other, that can be an issue. So if you're raising money on different terms at the same time, that's probably an issue. Other times we see that people raise money on a safe with a valuation of $10 million. And then a year later, they're not quite ready to do a price round, but that cap doesn't really make sense for their current business. They've had some growth, they've had some development. They now want to raise money on a $20 million cap, still with the safe. I think that's okay. Again, if there's some distance and separation, we're not raising on two separate, you've closed out this one, you're no longer raising on the first $10 million cap. So it's okay if there's some distance separation, you're only raising on one instrument at a time. Where it becomes complicated is if you kind of get past, I would say, 3 of those, anything more than I would say 3 sets of equity instruments, I think starts to become a problem. And the reason is this: oftentimes those instruments will convert into a different series of shadow preferred stock. So what that means is that they each have their own economics. And when they convert at their Series Seed stage, one would convert to a Series Seed 1, and one would convert into a Series Seed 2, and one would convert into a Series Seed 3. Well, under Delaware law, so this is a Delaware company, but also under, if you're a California company, California law, each of those series has its own special rights and protections that you can't contract away. So there are scenarios in which creating all of those series means that if you want to later do some type of transaction, you then have to get each of those subsets to agree to it. And that can be a challenge.
That's really interesting. And I did not know that. Really good to know. Going back to what you said about kind of the distance, the time and separation of, a safe at 10 million and a safe at 20 million a year later, I feel like many founders in that first pre-seed round, they'll raise a safe, let's call it a 5 million cap, and then somebody comes in like a month or two later and says, actually, I think I'm willing to invest, and I'll write you a decent sized check, but I want a 4.5 million cap. And so they do that, but it's only been like a month. Is that enough time?
There is no, I get asked this question all the time. And so I think this is a really good question. Unfortunately, there's no hard and fast rule. Like I can't say, hey, you had a week in between, you're probably fine. But what I can say is that probably the best thing to do in these types of scenarios are disclose. You need to tell your investors what's going on. So you need to tell your existing investors, hey, we're about to raise more money on better terms than we gave you. And sometimes the documents will deal with that. Sometimes the documents will say, hey, if you ever raise money on better terms, you have to give me those same terms. So sometimes there's an easy fix for it. Sometimes, and you also have to tell your new investor, by the way, we also raised money on these other terms. So we have other equity outstanding, other convertible equity outstanding. So I think kind of the best disinfectant is sunlight, generally speaking. So having conversations around that. Really where we see the problem, where this actually becomes an issue, is less kind of when people are doing these kind of, differing, instruments on differing terms. What happens is when they go to convert, everybody's going to look at the pro forma and they're going to say, whoa, John invested after me and he seems to have better terms. I'm not signing these documents. Like, what's going on here? And so that's when it becomes an issue and people start kicking up a fuss, and you really want to avoid that.
That seems like something that would be incredibly messy and expensive to go through.
Yep, absolutely.
Okay, so you've talked about simplicity is king, which I love that as kind of a title for this episode. What would a really great simple, like what's your kind of favorite simple cap table look like coming into a priced round? I mean,
So-
obviously founder only bootstrap would be the best, but like if that's not realistic. Okay. So like what's a great example of something that looks really clean?
So I think, like you said, again, simplicity is king. So if we're not doing just a simple founder cap table, I think a cap table is one that has these components where someone can look at it and see who owns exactly what percentage of the company. So, and when they acquired it and what type of equity is owned. So it is going to have sufficient detail to show you who are the people, what type of stock is out there, when did they acquire it. And I think those are all kind of really important pieces because you need to be able to someone needs to be able to take your cap table, compare it to all your documentation, and know that all those things line up. So, in contrast, a messy cap table might be something that's missing some or all of these features. Maybe it doesn't accurately reflect all of the equity that's granted. So maybe you have, I don't know, your board approves some founder stock grants at the beginning. You've gotten a whole bunch of stuff signed, but not all of it made it into the cap table. Or maybe you've made a whole bunch of equity promises. For example, you promised everybody and their mother some options. And so when you go to do your cap table, but obviously that doesn't go into the cap table, but it should be reflected as promised options, promised equity. You can keep a ledger for that promised equity so that the board can then approve it once you have your 409A. Or for example, it might include equity that hasn't been properly approved and isn't actually legally outstanding. That's not something we want. So you want a cap table that really shows factual, accurate information that is easily discernible by someone who knows nothing about your company. And I think that's always a good view to look at it. If I knew nothing about this company, would you have to give me a 30-minute primer for me to understand what's going on here? Or could I look at this and say, oh, okay, I get what's going on. I know kind of who acquired their equity and when.
That's really helpful. You mentioned 409A valuations, and I do want to touch on that. So when do companies need to have a 409A valuation? Why is that important when you've got this equity outstanding that has a valuation?
So usually what happens is kind of the rule of thumb is if you were granting options, so option, which is the promise, right? A contractual obligation to be able to, for someone to be able to buy stock at a certain price, a set price, then you need a 409A valuation, which is a third-party independent service comes in and says, your common stock is worth X only for these small tax purposes. And so what does that mean? The reason is the IRS has told us that you can grant equity and you can grant that kind of just based on the valuation of the board. Or if you grant options, you want to make sure that it is at not less than the fair market value on the date you grant it. And there is a safe harbor for getting that right. There's a safe harbor if you get a third party to give you that valuation. So at the end of the day, that means that you can grant your founder's equity, your founder's stock, without a 409A. You can grant early people stock without a 409A. And we see that fairly often, right? You kind of stick your finger in the air and you say, this company hasn't been around very long. My stock is worth 1/10 of a penny per share. That's perfectly normal and perfectly okay. Where we run into trouble is when companies without a third-party independent evaluation start trying to grant options. And that goes against 409A, and it can have some really significant tax consequences. So I recommend that companies never grant options without a 409A. The problem is that 409A valuations can be expensive, right? They're $2,000 to $5,000. Early stage companies don't just have that money lying around. So usually you will see a company get a 409A after their preferred stock financing. And that's when you absolutely have to get it. Sometimes they'll get it before. They want to grant options before. But absolutely after the preferred round financing, they will get a 409A so they can then grant options.
That was very helpful and very clear. Thank you for that. I'm learning a lot on this call, so I appreciate it. Okay, so what structures right now are you seeing more of in general, kind of at this early round, this sort of what used to be called seed and is now called pre-seed, and then there's like seed and seed extension, and There was kind of a boom in safes for a while. Before that, I think it was much more about convertible notes. What's happening today and kind of what structures are the most common?
Yeah, it is. It is funny because I'm with you. I feel like, the nomenclature around like what's a seed, what's an A, that's all kind of changed a little bit. I feel like what we used to call a Series A, like the metrics to raise a Series A, have kind of gotten pushed back. So we're seeing kind of bigger and bigger Series seed financings. But regardless of what you call it, my general rule is that for any fundraise in which you're raising less than $2.5 million, you really shouldn't do a price round. In that case, the juice it's just not worth the squeeze. So if you're going to do a fundraise below $2.5 million, that may be an indicator that the company is really just too early to do a priced round. You really don't need, you could potentially benefit from getting some convertible note, some money from a convertible note or a safe, and that will help you progress to the point where you really could be pricing your business at a better value. And then, of course, the legal fees associated with doing a priced round versus a safe or a note tend to be kind of exponentially higher. And then there's the administrative cost of doing it. Plus, when you do a preferred round, the people who are investing actually own stock in your company. They become voters. They're going to have special rights. They're going to have preferred stock, so they have preferred rights. And if a company is kind of too early, it's not worth it for them to give up those rights. That can really hamstring them. So for these kind of smaller fundraisers, we typically see either safes or convertible promissory notes. And I think there is, you're right that there was this kind of boom in people using safes. I think people really like it. I know founders really like it. I think there's this split between who likes safe and who likes notes. Obviously, at Fenwick, we're equally comfortable with both. But I think founders tend to like safes because they're short, they're simple. That can be dangerous because sometimes founders think they can do safes alone, not really realizing their securities laws they need to deal with, et cetera, et cetera. But they're easy to understand and they don't accrue interest and they don't have a maturity date. So those things I think are really attractive to founders. The problem with them, however, is that the IRS has not determined how safe should be treated. The IRS has not told us that even though they say they should be treated like equity, safes themselves say that, the IRS has not said that it's equity, and it also hasn't said that it's debt. So that can lead to some accounting issues. And also, safes can theoretically remain outstanding forever if there's no financing. So that can be a real downside for investors. So conversely, investors, especially kind of like your old school kind of institutional investors, they tend to like convertible notes. There's slightly more documentation involved there. It's not just a one simple kind of one-page document, but they are pretty straightforward documents. And there's a lot more definiteness around the documents. What happens if the company raises a preferred round? What happens if they don't? How is the IRS going to treat them? There's just a lot more kind of certainty around that I think investors tend to like.
That's really helpful context. And yeah, it is interesting that there's definitely comfort with different documents by different stakeholders in the process. So I want to kind of end with, what do you think is sort of either the biggest mistake that founders are making at the earliest stages on their cap tables, or like what really should they be focused on? And I know you've given us kind of a lot of advice already, but is there kind of one more piece of advice that you would give founders about their cap tables?
So I think it's probably two things. I think you should be working with counsel. Equity is the equity can seem simple, especially kind of early equity, but a lot of the mistakes that I see founders make with respect to equity and their cap table are things that are going to hit them in the pocketbook later. And those are the things that, it's just so gut wrenching to see someone pay a huge tax bill on stock that isn't fungible yet. And so I think that's kind of my first piece of advice is really just work with counsel. It doesn't necessarily have to be a huge firm, right? There are tons of really great solo practitioners that do this kind of day in and day out and can be really helpful. But the other kind of with respect to cap tables generally, the biggest mistake I see is poor record keeping. So too often we see companies that are on the precipice of a fundraise. They've got this great investor who wants to come in, only to discover that when they're kind of trying to model out their fundraise, they're trying to put together this pro forma, their cap table doesn't actually look the way they thought it did. And so maybe they've got lots of promised equity that didn't get kind of factored into these discussions. Maybe they failed to execute some paperwork, or maybe they've got some bad entries that actually kind of flow through the cap table. So poor record keeping, I think, is kind of the biggest mistake we see. I think I often hear founders come to me, at very early stage companies. They say, oh my gosh, you know what, we really messed up. We gave Bill too many shares, and we gave Susan too many shares. Like, what do we do? And those types of mistakes, things, we can fix those at the early stage, right? We can give people some more equity. We can figure out how to dilute people, as long as you have kind of the right power structure in place, we can figure it out. We can get people to the percentages they need to. Oftentimes we have people who just give shares back so they can rebalance the cap table. So that type of stuff, it's not insurmountable, but the messy record keeping can be painful and expensive.
Yeah, I did see an investment that didn't end up happening because the cap table recording was so messy that a lot of interesting stuff came up at the last minute, and then the lead investor walked away. So I think it can be very onerous to not have good records. Okay, Allison, this was amazing. Thank you for sharing kind of all your knowledge and all your advice around cap tables on this podcast episode. I really appreciate your time today.
It was a pleasure being here. Thank you for having me.
Thanks. And thank you all for listening to the RetailX podcast. We'll have another new episode out shortly. Thanks for listening. If you'd like to attend a RetailX Series event, check out www.retailxseries.com for upcoming virtual events and recordings of past events. You can also follow us on Twitter and Instagram at RetailX Series. You can also learn more about me, find fundraising resources, or submit a pitch deck at www.redgiraffeadvisors.com. Thanks, and catch you next time.